back to the Retirement Report. I'm Hank Parrott, your host. Joining me today, my good friend and special guest, Dr. Friday with Dr. Friday's tax and financial firm over in Brentwood, Tennessee. She's a tax expert for both individuals and small business owners. As I had mentioned, she does my taxes. One of the things you may want to, small business owners in particular, this is one of those areas you've got a business to run and to take care of. The last thing you need to be dealing with are payroll taxes, and yet these are some of the biggest risks for small business owners as well. You don't want to get into trouble on your taxes by not having all these things done, and it's unfortunately one of the areas for small business owners that's they get in trouble a lot is payroll taxes. It's one that's real easy to get behind, to not take care of that, and all of a sudden you're in a bind, and again, not a good thing. So have someone on board to take care of that for you, that can do your payroll, take care of your payroll taxes, file all the different reports that need to be filed so you can focus on your business. One of the things that we're going to be talking about, and so again, I would highly recommend Friday for that, if for those small business owners in particular, but even individuals as well. In fact, one of the areas I find many times with new clients when they're coming in is they're paying an exorbitant amount to have taxes done. And it may have been that, in past years, previous years, they may have had rental properties or they may have had a business they were running, but then they've transitioned into retirement and it's changed and it's simplified quite a bit. And as a result, they're still paying an exorbitant amount when, they could get that done for a lot less. And so that's another area, making sure that you're not overpaying for tax preparation. When it comes into the program today, we're talking about the three categories before the break, three categories of retirement income, that of taxable, tax deferred, and tax free. So what I want to do is talk to you a little bit about these individual ones, and we'll start with the taxable sources on that next slide. And Friday, you can go ahead and share a little bit on this chart.
So it says retirement and earnings and withdrawals you've taken from your pension, stock portfolio, savings, etc., are considered to be part of your income. First category we're talking about is taxable income. And this is really important to understand what taxable means. So earnings, sales, withdrawals from investments such as stocks, bonds, bank accounts, and money market accounts. Interest, dividends, capital gains are taxed in the year they are earned, rather than retirement. So when you put money into a 401k, you don't pay tax at that point. You pay tax when you take it out. But when you're earning interest or dividends or capital gains in an after-tax account, you pay it even though you may be reinvesting the money. And that I had a big problem with, Hank. The other day I had a client come in and the IRS assessed him a big dollar amount because he didn't realize that he had a portfolio account that he was an after-tax account, and he thought it was an IRA apparently. But anyways, so lots of tax problems can come up, and that hurts. Interest and dividends may be subjected to ordinary income tax depending on the type of bond or the type of dividends earned when it was purchased. And of course, Social Security income, a portion of that, up to 85%, can be taxable. I have so many people that have this misconception with Social Security that they're told that once they hit 60, their full retirement age, they don't have to worry about taxing. And that, my friends, I wish I could tell you is true, that it's a myth.
Yeah, it's one of those areas. I know it's a common one that people think are not going to have to pay tax on their Social Security benefits, and unfortunately, over the years, that has gone from 50 up to 50% of your benefits could be taxed up to 85%. So one of those areas when it comes to taxes is understanding. It's important. We'll get into in fact later here as we go through the morning about the provisional income formula and how that works. But
how
let's
they haven't adjusted it for years, so that more people are falling into it.
Exactly.
We'll
inflation comes in. You're
huge
when
difference.
You're looking at inflation and seeing your income go up over the years, this threshold that that was set by the IRS or Congress, if you will, has never changed. It doesn't increase with inflation, so more and more people each year end up having to pay tax on their Social Security benefits. Now, the other thing, we just talked about taxable sources of retirement income. The next one is your capital gains tax. So first was ordinary. Now let's look at capital gains taxes and how those work.
This one is more fun as far as I'm concerned, okay? Because we have that zero. So for individuals individuals that make, and I'm going to, well, anyway, 0 to 41,675, or a married couple making 0 to 83,350, or head of household 55,800, that's zero. So that, let me clarify, that is total income. That isn't just what you have in capital gains. This would include all taxable income, interest, dividends, W-2s, whatever you might have.
And just to make sure we're clear on that, when we're talking about married filing jointly, that $83,350, again, that's the taxable. That's after your standard deduction has been added. That's what I was going to add in there,
because I'm like, it's really kind of a little higher. But you have, when the numbers we're reading or you see on the screen, that would be after your standard deduction or your itemized deduction. Whatever your deduction, this would be what we call taxable income.
So that means, you know, just to even more beat it down.
That's right, put it in there.
That means 111,000 AGI, or adjusted gross income of 111.
If
you're
taking
still
the
at a
standard
zero,
deduction,
including the gain. If you had it in that year, you would have a zero capital gains tax rate.
Right. And then if you do exceed it, because it happens, people, all the time. So we exceed it, and then the next thing will go into the 15% tax bracket. So for an individual, that basically, if you go over that 41,000 up to $258,600. For a married couple, once you exceed, so anywhere between, for a single person, anywhere between that 41 and that 258,000, that would be taxed at 15% capital gains rates. For married couples, it's the 80,800 all the way up to 517, and then for head of household, 55 or 488.5. So that's a really important threshold to understand, because the inside that threshold, and I know they don't put it on here, but I have to put it out there, Hank. It's just me. There is also what's called the Medicare tax. So theoretically, if an individual, to stay in the 15% tax bracket, they basically have to stay under $250,000 total income to stay in 15. If you go over that, you're going to get an additional tax called the Medicare tax, which is 3.8%. So, and for married couples, there's a married penalty in this. So if you have ordinary income and capital gains tax that exceed $250,000, your capital gains rate for everything above it, now not all of it, but for anything that goes above it, is actually going to go to 18.8. So it's really important, again, because within the tax code, there are always extra codes. We talk about the provisional tax code. This is an additional penalty. I mean, wage earners, right? If you make over a certain dollar amount, there's a 0.8 tax that is added in as an additional penalty once you make over 250 for single, or 200 for, 200 for single, or 250 on wages. Understanding this, and I know I'm veering off a little bit onto my little rant, Hank, but that's important, because if you're calculating and you made $258,000 and you calculate at 15%, you're likely to be slightly underestimating your taxes. Yeah, is all I'm saying. And the same thing.
There's important rules that Dr. Friday is sharing with you here. We can go ahead and get that slide down for a little bit.
Because Friday's veering off. No.
I know. No. Well, this is one of those areas that, again, exceptions to the code, right? This is, we talk about there are rules and there are exceptions to rules and exceptions to exceptions, right? To understand everything and how these are going to work, it's important to understand these exceptions as well. So here's one of the distinctions. We talked about the progressive nature of the tax code, and that means if you go above 10%, the 10% bracket, you go into the 12%. Only the amount that's in the 12% is taxed at 12. This is different though with capital gains. You cross that threshold, and it's not just the amount that went over that's taxed at 15. Now the entire gain becomes taxed. Now think about that. Let's say you got $50,000 in taxable income, and you're going to sell off a bunch of stock, and that stock is going to, let's say, $50,000 worth, or even 60. We'll take it right up to it. And I say I put 60 on my capital gains. 60 plus 50 is 110. I'm under the 111 AGI threshold. Therefore, zero tax on that 60,000 in gain. But if I mess up and I did my calculations, and all of a sudden, instead of 110,000, my gain puts me at 112, just 1,000 over
pennies over
that bracket. and boom, I'm paying now 15% tax on that whole $60,000.
Right.
Now I've got a $9,000 tax instead of a zero tax. This is important to understand
Yes.
how these work, and when we're putting together a tax efficient plan, how we balance all this out.
Right.
So I'm going to use that gain, let's say, to think about it this way. I need $100,000 to live on, right? That's
Yep.
my lifestyle expenses. So I need $100,000 a year, let's say, to support my lifestyle. I've got $50,000, let's say, from Social Security combined
Pensions
for a
and
married
everything.
couple
Yes.
over 65. Now that gives me, right, I get $60,000 here. I need another 50 to supplement. Now, do I take it from, maybe I sell some stocks, right, as one option, or I'm taking
IRA.
money from my IRA, right? Or my Roth IRA. Which one am I going to do? Well, if I take it from my IRA, I can do that and only pay a 12% tax on it, okay? If I'm going to, now let me finish this example.
Okay,
so I can do that and just pay 12%. I can use capital gains and have zero, right? Or Roth and use up some of my tax-free benefits and still have a zero tax. Which is going to be the best way to go? And the answer is going to depend on your individual situation, because we want to look into the future, right? When I'm talking about showing you your financial future, it's part of your planning as well. So for instance, I want to at least look ahead until age 72, right? When you hit your required minimum distribution age, right? Now, what is because that's going to make me start taking money out. What is that going to do as far as my taxes at that point? So when we're developing a long-term plan, which helps us then determine what we're going to do in the short term, we've got to look at all of that and get those projections done. These are questions you want to ask your advisor. If they don't do this kind of work, again, give us a call, 615-376-5325. We'll get that number up a couple of times through the show. So again, if you need some help with taxes and putting together a tax plan, we can help with that. This is one of those areas, again, with capital gains rates. If you've got some highly appreciated assets and we can use that throughout your retirement years, you know, this could be a big boost in terms of helping us get the income. I just use an example, $50,000 in Social Security. I need $100,000 to live on. How I can do that? Well, when we come back, I'm going to take that a step further. What if I need $150,000 for my lifestyle? How would I then balance those different pots of money out at that point? First a break. Join us here. We'll be right back on the Retirement Report.